Welcome, welcome. What's up, guys? I'm the Excel controller. Today we are taking control of the data. What transforms a spreadsheet from a sea of numbers into a powerful financial tool? The answer is simple: formulas. If you lead finance, accounting, or business operations, mastering formulas is one of the most valuable skills you can develop. Every month, controllers face familiar questions. How much revenue did we generate? How much did we spend? What is our variance percentage? What changed from last month? Which department is driving the results? These questions sound straightforward, but consistently answering them and doing it quickly requires more than just manual calculations. Picture this. It's the first morning after month end. You open a report filled with thousands of transactions. By afternoon, leadership expects a budget versus actual summary. Manual calculations might seem tempting, but they introduce unnecessary work and open the door to errors. Multiply that by every month and the inefficiency compounds. This is where formulas become your best ally. With the right formulas, totals, differences, percentages, and logical tests update automatically, adapting as your data changes. This turns your reporting workflow into a repeatable, efficient process, saving hours and boosting reliability. Today, we're starting with the fundamentals. We'll build basic formulas, then apply them in a controller scenario, covering core techniques, calculating totals, finding differences, managing percentages, using logical checks, and handling errors. Along the way, we'll see how formulas support budgeting, forecasting, reconciliations, revenue analysis, and management reporting. Remember, the goal isn't to memorize every Excel function. It's about understanding how formulas work and using them to solve real business challenges. By the end, you'll feel confident creating financial reports that are accurate, dynamic, and ready for leadership. Let's turn frustration into empowerment and build the skills that elevate your workflow, one formula at a time. Before we build our first example, let's understand what an Excel formula actually is. A formula is an instruction that tells Excel how to calculate a result. Every formula begins with an equal sign. Click cell A1, type 100, press enter. Click cell A2, type 250, press enter. Click cell A3, type equals A1 plus A2 and press enter. The result is 350. Notice that I did not type the answer into cell A3. I told Excel how to calculate the answer. That distinction is important. The formula is stored in the cell, while Excel displays the result. Click cell A3 and look at the formula bar. The formula bar shows the actual formula, which is equal to A1 plus A2. This is one of the first habits I want you to develop. When reviewing a financial spreadsheet, don't just look at the number. Click the cell and inspect the formula behind it. Click cell B1, type 1000. Click B2, type 250. Click B3, type equals B1, B2, and press enter. Now Excel returns 750. We use the minus sign to calculate a difference. Click cell C1, type 1000. Click C2, type 250. Click C3, type equals C2/C1 and press enter. The result is 25% when we format the cell as a percentage. Click cell C3. On the Home tab, find a number group and click the percent style button. This is an important finance concept. When calculating a percentage variance, we divide the difference by the appropriate base amount. The formula structure matters just as much as the number itself. Enter 100 in D1, 200 in D2, and 300 in D3. Click D4 and type equal sum D1, D3. Press enter. The SUM function adds a range of cells. Instead of writing D1 plus D2 plus D3, we can tell Excel to add the entire range from D1 through D3. There are two important terms to understand. The cell reference identifies the cell Excel should use. The operator or function tells Excel what to do with that reference. For example, equal A1 plus A2 uses cell references and an addition operator. Equal SUM followed by A1 through A3 uses a function and a range. Now let's talk about one of the most common mistakes beginners make. They type the answer instead of building the formula. If revenue is 500,000 today, someone might simply type 500000 into the report. That number may be correct today, but if the underlying data changes tomorrow, the report will not update. A better approach is to reference the source data. That way, the report calculates the result from the underlying information. Another important habit is to avoid hard-coding numbers inside formulas whenever possible. If a tax rate, budget assumption, or growth percentage may change, put that assumption in its own cell and reference it. Finally, keep formulas consistent. If 5 rows calculate the same type of result, the formulas should generally follow the same pattern. Consistency makes a spreadsheet easier to audit. We're going to calculate the budget variance for each department. Start by clicking cell D2. In D2, type equal sign, select C2, minus sign, B2, and press enter. Excel subtracts the budget from the actual amount. The result is 22,000 for operations. Click D2. Move the pointer to the small square in the lower right corner of the cell. When the pointer becomes a plus sign, click and drag down through D6. Excel copies the formula down and automatically adjusts the row references. D3 now compares C3 to B3. D4 compares C4 to B4, and so on. This is called relative referencing. Excel adjusts the references based on where the formula is copied. Click cell E1 and type variance percent. In E2, type equal sign D2/B2. Press enter. Next, format E2 as a percentage from the Home tab. Copy the formula down through E6. Now we have both the dollar variance and the percentage variance. This gives us more context. A $22,000 variance means something different depending on the size of the budget. Let's look at a common mistake. Suppose someone calculates the percentage variance using actual revenue as the denominator instead of budget. The calculation may still produce a percentage, but it answers a different question. When building financial reports, always define what your denominator represents before writing the formula. Another common mistake is forgetting parentheses when a formula contains multiple operations. Excel follows a specific order of operations, so when a calculation becomes more complicated, use parentheses to make your intention clear. Always inspect formulas when something looks unusual. Don't assume the number is correct just because Excel accepted the formula. Now we're going to use formulas in a situation a controller may encounter during the monthly close. We have budget and actual results by account. Our first job is to calculate the dollar variance. Click D2. Click E2. Type =sign D2/B2. Press Enter. Format E2 as a percentage with 1 decimal place. Copy the formula through E6. Now we can see both the dollar impact and the relative impact. Let's think about how a controller would use this information. If payroll is $125,000 above budget, that's worth investigating. But the percentage tells us how significant the variance is relative to the original budget. Now we're going to add a total row. We will use this sum. Formula for budget and for actual, summarizing each column respectively. We are also going to use sum. Formula to find a variance of total actual and total budget. Then sum. Formula for variance, dividing actual versus budget for the percentage. We'll do a small formatting of the total row so that it stands out. And now we have a total for the report. Notice that we calculated the total using the underlying rows instead of manually typing the answer. This is an important controller principle. Whenever possible, build the report so the totals are calculated from a detail. That creates an audit trail and makes the report easier to update. Now imagine actual results change tomorrow. Payroll increases. Revenue changes. Fuel expense is updated. Because our report is formula-driven, the calculations update when the source values change. Look at the payroll variance. It updates automatically. The total actual amount also updates, and so does the total variance. This is why formulas matter. We have created a small reporting model rather than a static report. The same principle applies to forecasting. If we replace actual assumptions with forecast assumptions, our formulas can calculate the projected result. The same principle applies to reconciliations. We can compare two values and calculate the difference. It applies to revenue tracking, payroll analysis, and executive reporting as well. The formula itself may be simple. The value comes from creating a repeatable process that can be updated without rebuilding the report every month. Now let's build a more advanced example using regional operating data. Add column F and name it operating profit. In F2, type =sign B2 minus sign C2 minus sign D2. Press Enter. Copy the formula down through F5. Operating profit is calculated by taking revenue and subtracting payroll and operating expenses. Add column G named profit margin. In G2, type =sign F2/B2. Press Enter. Format G2 as a percentage with 1 decimal place. Copy through G5. Now we have an operating profit margin for each region. Add column H named revenue per employee. In H2, type =sign B2/E2. Press Enter. Format H2 as accounting with no decimal places. Copy through H5. This gives us another operational KPI. Revenue per employee can help us understand productivity and compare regions with different staffing levels. Notice what happened. We started with 5 source columns and created 3 useful financial and operational measures from them. This is how formulas support management reporting. The source data provides the facts. The formulas turn those facts into information that management can use. Add a total row below the regions. Calculate total revenue, payroll, operating expense, employees, and operating profit using SUM. Calculate total profit margin as total operating profit divided by total revenue. One important point here is that we should not simply average the regional profit margins to calculate the company-wide margin. The correct approach is to calculate total operating profit divided by total revenue. That gives us a weighted result based on the actual business volumes. This is a good example of why understanding the business meaning behind a formula is just as important as knowing the Excel syntax. Now let's review some of the most common formula problems. Excel returns a div/0 error because we attempted to divide by 0. Depending on the contents, Excel may return a value error. The important point is that the formula is expecting compatible values. You may also encounter a REF error. That usually means a formula is referring to a cell or range that no longer exists, often because a referenced row or column was deleted. When auditing a report, start with the formula itself. Confirm the reference cells are correct. Then check whether the source data is correct. Here is a simple controller quality control checklist. First, verify the source data. Second, verify the formulas. Third, compare calculated totals to the source report. Fourth, investigate unusual variances. Fifth, review formulas that were copied across multiple rows. Another useful check is to calculate a result a second way when the amount is important. For example, if total revenue is critical, compare the formula total to the accounting system total. If the numbers do not agree, stop and investigate before distributing the report. Never hide an error simply because you don't like how it looks. An error is information. Find out why it occurred and correct the underlying issue. Now it's time to practice. I've created a workbook for this lesson with financial information you can use to build your own formulas. Start with a budget versus actual worksheet. Next, move to the regional performance worksheet. Finally, use the revenue tracking worksheet. Don't just enter the answers manually. Build formulas that calculate the answers from the underlying data. When you finish, change one of the source values and watch your formulas update. That is the behavior we're looking for. The goal of this exercise is not to see how quickly you can type formulas. The goal is to understand the relationship between source data, formulas, and the final result. Today, we covered the foundation of Excel formulas for finance professionals. We learned how formulas use cell references, operators, ranges, and functions. We calculated totals, dollar variances, percentage variances, operating profit, profit margins, and revenue per employee. More importantly, we saw how formulas support real, controller responsibilities. Budgeting requires formulas to compare planned and actual results. Forecasting requires formulas to project future results. Reconciliations use formulas to identify differences between two sources. Financial reporting uses formulas to aggregate and present results. Dashboards use formulas to calculate the key performance indicators management wants to see. Operational analytics uses formulas to turn raw business activity into useful measures. The biggest lesson is simple. Don't build reports that require you to manually recalculate the same information every month. Build formulas that do the work for you. Download the practice workbook and complete the exercises. Change the source numbers after you finish and make sure your formulas update correctly. In the next lesson, we'll take our formula skills one step further and focus on some of the most useful functions for financial analysis, including SUMIF, SUMIFs, and other functions that allow you to analyze large amounts of business data without manually sorting through thousands of rows. Thanks for watching Excel Controller. I'll see you in the next lesson.